Okay, good evening, everyone. Thank you for joining us this evening for our program, DIY Investing, Understanding the Fundamentals of Investing on Your Own, which is part of Investor Education Month. Before we start the program, as part of my journey in reconciliation and out of deep respect for the First Nations and Métis people who live in what is now called Canada, their history and their culture, I would like to acknowledge that I live, work, read, and play on Treaty 6 and Treaty 7 nations, as well as the Métis of Region 3. This land acknowledgement is just part of our commitment to work towards a better and more fair relationship with all Indigenous peoples. So our speaker tonight is James MacTavish, who is a senior advisor, investor, and industry education with the Alberta Securities Commission. Welcome, James. And it's been great having you here with all of our investment programs. And tonight we're going to find out about understanding the fundamentals, I can't speak tonight apparently, of investing on your own.
It's all good. I'll take over. Don't worry.
There you go. That's good. You can speak.
Awesome. All right. You can see my screen all right? Perfect. Well, hi, everyone. Thank you for joining me in Investor Education Month, October. And really, DIY investing has been something that everyone is talking about, everyone wants to jump into, but really might be missing the fundamentals of how to invest correctly with this method, or even if it's the right method for themselves. So for today's presentation, we'll be walking through what DIY investing is, if it's right for you, and really how you go about investing in companies, doing the research around it, and really opening up an account and doing all the necessary actions that it takes to invest as a DIY investor. So let's get started. So just a quick reminder for everyone that today's presentation is to provide helpful information about securities and is not intended to provide legal, accounting, or other professional advice. So who are we? If you haven't heard of the Alberta Securities Commission, you're not alone. We get that a lot. We try not to take it personally. The ASC is a regulatory agency responsible for administering the province's securities laws. So we have about 200 employees who create and enforce the laws, rules, and regulations that govern the Alberta capital market. While we report to the Alberta government, we are funded by market participants. So what does that look like? Well, when a financial advisor registers for us or a company goes public, they pay us fees as a means to ensure a fair and efficient capital market and investor protection. And because we're not trying to sell you any type of investment product, we can provide you with independent, unbiased information and tools so you can make informed investment decisions. So we will never ever tell you what stock or what type of investment fund to get into, but we can certainly tell you how to research and make sure that you can find out if it's suitable for your needs and risk tolerance. So what we'll talk about today is what is self-directed investing, pros and cons of investing on your own, how to determine if self-directed investing is right for you, other ways to manage your money and investments, and investing fundamentals. So let's jump in. So what is self-directed investing? And really at the core of it is doing it yourself. It's a concept of putting you in the driver's seat with full control over the creation and management of your investment portfolio. So let's dive into what you should consider and know before enrolling in self-directed investing, because it's not for everyone. One thing I hear a lot is day trading is DIY investing, and they are exactly the same. And so when people think of DIY investing, they're thinking of approaching it as a day trader. Couldn't be further from the truth. Day trading is a DIY investing strategy that is high risk with a focus on short-term buying and selling of securities to capitalize on moment-to-moment fluctuating values of investments. This investing strategy is not recommended for a beginner and is very complex. You can easily lose money being a day trader. When we talk about DIY investing and what we'll walk through in this presentation, we'll show you how to become a DIY investor and approach it with long-term mentality of reaching your goals, both short, medium, and long-term, and really being diligent about that. It's not about day trading and doing rapid trades in a day. Though, once you build up your experience with DIY investing, you may want to approach day trading, but it is very complex and high risk. So advantages of DIY investing. Well, if you're considering opening a self-directed investing account, there are things you should keep in mind. DIY investing is ideal for the individual who understands the fundamentals of researching and analyzing investments and wants to manage their portfolio without the support of an advisor or robo-advisor. DIY investing also allows you to deploy your own investing strategies and curate the investments you think best help you achieve your financial goals. If you're really interested in technology stocks, or you're really interested in maybe niche furniture suppliers, the sky's the limit. So when it comes to DIY investing, you can invest in whatever piques your interest. And other benefits is potentially lower fees if you approach it correctly and you go for low cost investment products, as well as it allows you to engage in the market and track things that interest you, like I was saying before. And finally, full control over your investments. Because you're managing everything, you get to manipulate and control every single component. For some, that might be too much, but for others, they might really crave that type of control with their investing. And that's what DIY offers. Now, disadvantages of DIY investing. While investing on your own has grown in popularity these days, it's not without its disadvantages and things that people should contemplate before getting started. Without a confident understanding of investing fundamentals like researching, as well as the functions of online brokerages for trading, you can make costly mistakes with your hard-earned money, with mistaken trades and unsuitable investments that do not meet your risk tolerance. Additionally, investing on your own is only as worthwhile as the time you dedicate to it to ensure you're aligned to your financial plan, tracking your investments, and doing the research before making trades. If you don't have the time to dedicate to the ongoing management of your investment portfolio, like a plant in a garden, it may wither. So really, you have to look at this as something that you have to nurture and monitor and grow over time. If you don't have that time, it's probably not the right path for you. And the other disadvantages of DIY investing is the convenience of today's online brokerage platforms allow investors to easily place trades and monitor their accounts like never before. This is great. But the speed and convenience, though, can be a double-edged sword for impulsive or emotional investors who can make costly decisions impromptu. You might see one of your investments drop 20% in a day, and you might be inclined to sell it, where if you took a long-term view of it, you'd know that this company is very secure, it has products that are going to make it grow over time, and you would stay with it. But for that emotional person, a 20% drop might be too much to handle, and they might cash out. And finally, without the backbone of a strong financial plan and goals to aim for before you start, DIY investing can bring out your worst traits. Fear of missing out, anxiety, distraction, all of these can play into how you pick your investments. And it's so easy to forget about your financial plan and your goals. So with that, how do you determine if DIY investing is right for you? Well, we've broken it down into 4 main categories that you can ask yourself about to see if DIY investing is right for you. The first is know yourself. Do you understand your risk profile and feel you can confidently judge an investment that is suitable for you? Now, your risk profile is your risk versus return. Now, for any type of investment, there's going to be a level of risk you would have to take for a level of return. This is always high risk and high return, low risk, low return. You can actually take a risk profile quiz at checkfirst.ca, and that can help you identify what level of risk tolerance you have. When you know that, you need to stay focused on matching your investments to your risk tolerance. By going over it can cause you a lot of anxiety, a lot of fear, and is really pushing yourself out of your comfort zone. Make sure you stay within that suitability of your risk tolerance. So you have to know yourself. And do you know how to confidently judge an investment for yourself? We're going to talk about how to do fundamental analysis on investments, but it's going to require you to do much more studying on your own to better identify the types of investments you want to get into. The next is investment literacy. Do you understand the different investments available and the way you can trade them? Do you understand how to read investment information and conduct thorough research on fundamentals? This is critical when it comes to investing. And if you don't, these are things that you need to study first and read up on and understand. We have programs at the end of this that I'll talk about. There you can sign up for Investing 101. That'd be great for you to brush up your knowledge on that. Emotional discipline. Consider, do you have emotions that ever play a role in your investing? Do you ever see emotions play out in your day-to-day life? Do you have emotions when it comes to buying something on sale, or buying something in a comboed bundle because it's got that much of a discount and you jump on it? Do you have that type of thrill, or do you have do you feel sad if you miss out on a sale? These are all elements that can help you key into whether you maybe have an emotional angle that might hurt you as a DIY investor. These are things you need to think about and contemplate beforehand. And finally, dedication. Like I was mentioning earlier, do you have the interest, the bandwidth, and dedication to invest on your own, but also to learn about the capital markets as they change over time? It's a constantly evolving world, and everything is changing around us. So you have to stay abreast of that information and the changes. If you don't have that, it might not be right for you. So if you've looked at those four columns, or those four boxes, and you might have said, no, I don't maybe have the emotional discipline, or I don't have the time to dedicate. What are other ways to manage and invest your money? Well, that's great that you asked. There is a variety of different ways that you can invest, and none of them are wrong. So it's really about picking the right one for you. The first is investing with a financial advisor. And using a financial advisor for your investing journey allows you to lean on the expertise of specialists to help you define and roadmap your investment strategy to meet your goals. And much like Google Maps giving you new directions when you miss a turn, a financial advisor can help you adjust your investment strategy and portfolio as you go through life. This approach is great for someone who may lack the financial knowledge, experience, or interest to take on DIY investing. And working with an advisor can help you build out a comprehensive financial plan and the bundled services to get you there. Pretty awesome stuff. And it's best for someone who has limited time, interest, financial knowledge, or experience, but knows that to grow their wealth, they have to invest. It also is for someone who's looking for that comprehensive financial plan and the bundled services from a professional. They want the whole investment portfolio told to them and how that's going to help them meet their goals. And a great way to do that is through a financial advisor. And finally, wants personalized feedback and services. Part of having a financial advisor is someone that you can lean on when you have questions about certain types of investments, about your investment portfolio's performance. They're there to help answer those questions. So by having that, it really provides that necessary feedback that you do not get as a DIY investor doing it all on your own. And keep in mind that an advisor may have an investment product bias, offering you investments from his or her own firm, but they will tell you about other investments that can meet that same level of goals and suitability for yourself. You can always tell them if you're not okay with an investment product, and you do not have to take it. So remember that when you're working with a financial advisor, that it's a relationship in your best interest. If you're not comfortable with a certain investment portfolio, product, or approach, you can tell your advisor or find a new one. When considering using an advisor, keep in mind that this is a relationship. If you do not feel comfortable with the advisor or the plan he or she has laid out for you, again, do not have to accept it. Additionally, the relationship only succeeds if you are transparent and open about the risk tolerance, your goals, and what you need. Without being honest on these pieces, you may give the advisor the wrong understanding of what you need from your investments, and you might not like the results because of that. The next is investing with a robo-advisor. And this is really almost retains some of that DIY elements of handling investment strategy and portfolio on your own, but also relying on a robo-advisor platform. That is a series of complex mathematical rules and algorithms designed in collaboration with investment managers, financial advisors, and data scientists. These algorithms' common goal is to provide investors with a standardized investing portfolio aligned to the desired risk preference, time horizon, and expected return range. So it gives you that element of, picking out or answering questions based off of your time horizon, what you need, and getting a pre-templated investment portfolio that you can utilize for your investing journey. This option is best for someone who would like to take on investing on their own, but still utilize portfolios created by wealth managers that have baked in diversification, rebalancing, and low fees. As you may already know from the description of what a robo-advisor is, the major element to keep in mind is that none of the portfolios are personalized to your needs, but rather a graded scale based on your risk tolerance and time horizon. If you want a more customized portfolio to your needs and exact goals, then you may want to work with an advisor. Remember, if you do not choose to go the robo-advisor route, or if you do choose to go the robo-advisor route, always be honest with yourself when answering the profile questions upon opening your account. This will ensure you get an appropriate profile that portfolio that suits your needs, meets your risk tolerance, and defines an investing path that you can stick with and not lose sleep over. That is super, super important. So now that we've gone through the different types of investing strategies, and maybe you, after reviewing everything that I've just talked about, say, DIY investing is still right for me. Let's dive in. How do we approach DIY investing? Well, the first is to open a self-directed account. Generally speaking, a self-directed investment account can be opened at most financial institutions and online discount brokerages. Before opening an account, take the time to review the fees associated with self-directed accounts and what types of securities you will be able to hold within them. Not all carry the same fee structure or hold every security you may be interested in. This is crucially important. So make sure you take that time before you open up any account with any online brokerage or financial institution. Take that time to research what they have on offer and what aligns to your fee structure and needs. Investing accounts can be held in both registered and unregistered accounts. Taking a look at registered accounts, investors have a variety of avenues to manage their investments. The first is TFSAs, tax-free savings accounts, and they allow the capital gains on your investments to be tax-free. While this is great, it's also worth noting that any investment losses are not eligible for a tax loss deductible, as you would get in an unregistered account. The current maximum you can contribute to your TFSA if you were 18 when it launched in 2009 is $75,500, with an additional $6,000 of additional contribution room added each year for consideration of inflation. The next is RRSP, and this is a registered retirement savings plan. And they're not just for holding cash, a common misconception. You can also invest in it with taxes deferred until withdrawal, ideally in retirement. Contribution room is 18% of your earned income from the year prior and any carry forward contribution room from prior years. This is a really powerful account because it your taxes are deferred until you're in your retirement years, where it's going to be lower than in your working years. And when you contribute to your RSP, you're going to get money back based off of that tax deferred. So you're getting that taxes deferred, so you're getting that money back to you, which is your own money, and you can reinvest that into your RSP or put it into your TFSA. But this is a great way to save for your retirement. The next is RESP, and this is the Registered Education Savings Plan. And these are a great way to invest in your child's post-secondary education. Every year that you add up to $2,500 to your child's RESP, the federal government will provide you with up to a $500 grant for a total of $7,200 over the lifetime of the RESP. That's a 20% return on every dollar before you ever invest it. That's super powerful. And as post-secondary school gets more and more expensive, the more we can do to save for our child's education early, the more we can leave them with a larger nest egg that they can utilize when they hit school. The next is RDSP. And this is the Registered Disability Savings Plan. And this is a long-term savings plan to help Canadians with disabilities and their families save for the future. You have a total lifetime contribution limit of $200,000, which also includes a matching grant from the federal government of $3,500 per year, up to $70,000. Very, very important accounts if you have goals like saving for your child's education, your retirement, a house down payment. These are all accounts that you can leverage for that. And finally, unregistered accounts. These accounts have no limitations and investment losses are eligible for a tax loss deductible. Additionally, capital gains are taxed at your marginal tax rate in the year they were withdrawn. All of these accounts' unique benefits help Canadian investors achieve their short, medium, and long-term goals for themselves and their loved ones. So, before you start investing, it's important to build a financial plan. I've mentioned it a few times, but you need a financial plan to guide and really track your investments too. With the goals you're aiming to achieve with your investments. Without it, you're susceptible to unsuitable investments and fraudsters who capitalize on your lack of direction and goal setting to sell you on enticing investments that are really a scam. Building out and following a financial plan consists of 4 main steps that seem easy, but require you to stay focused, especially as a DIY investor. The first is to start mapping out your financial goals. Each of these goals will have varying time horizons, and as such, the appropriate investments to achieve may be different. You want to map out your short-term goals that you want to achieve within the next 6 to 5 years, midterm goals that you want to achieve in the next 5 to 10 years, and long-term goals you want to achieve in 10 years or more. Next, you want to assess your budget to understand what you can contribute to your savings and investing consistently on a monthly basis. The more consistent you are, the better off you can be. This is important as the more you can automate your investing each month, the more consistent you can be in contributing and growing your wealth over time. CheckFirst has a great budget calculator you can use for this as well. Step 3, with your goals in place and an understanding of what you can contribute, the next step is to understand your risk tolerance, which is your ability and willingness to take risk. CheckFirst has that great risk tolerance quiz I mentioned earlier that you can utilize, and following that, what investments you can best help you reach your goals. So for example, for short-term goals like a vacation, you may opt to go for a low-risk investment like a GIC or bonds, which have very, very low risk of you losing your money. For a midterm goal, you may want to use more risk with stocks or investment funds, and long-term goals, you may want to use more high-risk investments or diversified and low-risk index funds or ETFs. It's really your investment journey, and it really is about tracking to your risk tolerance. Across your investment portfolio, it's useful to remember that diversification can help you reach steadier returns and spread risk across different industries, sectors, and companies. So instead of just buying into one company, you're buying in a variety of different companies. Instead of buying in just one sector like technology, you're buying into a bunch to help hedge your bets against any one sector or any one company doing really poorly for the year. You have others to buoy you in and still give you returns. And finally, step 4, invest consistently. So once you're all planned out, you want to begin your consistent contribution to your portfolio. By staying consistent and focused and always adding funds to your portfolio, you can grow your investments and reach your investment goals over time. So financial plan considerations. Well, first is while building out the plan for your investing strategy, a good rule of thumb is to create an emergency fund either in a savings account or high interest savings account that you can help you with unexpected expenses like a car breaking down without you having to remove your funds from your investments to pay for it. 2, consumer debt like a credit card with an interest rate of the standard 19.99% can eat heavily into your available funds for investing and day-to-day life. By eliminating those types of debts, first, you can avoid negating your returns from your investments. 3, if one of your investing goals is retirement, contemplate if you need to save extra for any health expenses. If you have pre-existing conditions, you may want to factor that into how much you're looking to have for your investments and savings when you go to withdraw them in your older years. And 4, financial planners. If you're having difficulty mapping out your financial plan for investing, you don't have to do it alone. You can utilize a financial planner or qualified financial advisors to help you define your goals and the investment strategy you can use to meet them. So now that we talked about your financial plan, let's talk about the types of investments. There are a variety of investment types, and depending on your preference, risk tolerance, financial plan, and goals can be used in combination or just a select few. The first is cash equivalencies, and these are, like it says, a generally secure investment. They're very, very low risk, very low returns. It's not very likely that you'll lose money with these, and it's great for those short-term goals. The next is fixed income securities, and these are really like lending and borrowing money and getting interest paid back on that. But the thing to remember here is that they're a little less liquid than cash equivalencies, but do provide a little bit higher return. The other thing to note here is that the risk is a little bit higher because there is bonds that can be defaulted on, but it's very, very rare. The risk is still very low. The next is equities, and this is what a lot of people think of when they think about investing right off the bat, is stocks and shares, and they represent part ownership of a business. So returns from equities come either from dividends, which is the profits from the business, or by selling the shares, which if they've grown in value is called a capital gain. And examples of this are common shares and preferred shares. The risk here is variable because there's a variety of different companies, both in high risk sectors, low risk sectors, and doing different things, either being very innovative or just making cereal. There's a variety of different companies from Kellogg's to Tesla, and they all have their different levels of risk. And investment funds. These are professionally managed or passively managed funds or portfolios invested in a diverse combination of assets. And we'll talk about what passively and actively managed are. But think of it as like equities being you're buying a single egg, whereas investment funds, you're buying a whole basket of eggs. Remember that component of diversification? Well, investment funds are a great way to develop that diversification with your investment portfolio and spread your risk out. The thing to be mindful of this is that the risk is still variable. There is a variety of different investment funds out there with a variety of different levels of risk. There's some that can be very low risk and some that can be very high risk. There's even some that specialize in cryptocurrencies. So it just goes to show you that just because you are investing in a variety of different securities within an investment fund does not mean that means that the risk is lower. You definitely have to look at the investment fund fact sheets that come with any type of mutual fund or exchange traded fund that will tell you what its objectives are and the level of risk that is associated with that investment fund. So make sure you look at that before getting involved with those. And finally, alternative investments. And these are unconventional and complex investments, crypto assets, digital assets, private equity, derivative contracts. These are all very complex and they have the potential for that high return, but also higher risk. So these are things that you can learn about first before getting involved in. It's not something you jump into right off the bat. Now, active versus passive investing. As DIY investors, you have two strategies for approaching your investing journey. Active investing, in which either you or an advisor curate investments on an ongoing basis, or passive investing, in which you use index funds or broadly diversified investments that track the market and have little to no human manipulation to hold for the medium to long term, and relying on the fundamental idea that markets continually increase in value over time. We'll go further into this. Active investing, like stock picking, can produce higher returns than passive investing, but carries with it higher risk. Historically, passive investing has outperformed active investing over medium and long-term horizons. Stock picking in particular requires investors to be dedicated to consistently reviewing and assessing their investments for the opportunities to buy and sell. Another key thing to note is that most actively managed portfolios and investment funds are generally more expensive than passively managed ones. When considering the strategy you would like to use for your self-directed investing, do not feel like you have to choose either active or passive. Commonly, investors will focus on a majority of their investing portfolio to passive investing and a small percentage to active investing. But this is your investment journey, and the blend of strategy you find best is unique to your preferences, risk tolerance, and financial goals. So take some time to review it and map it out before you start. So for many prospective DIY investors, the ability to invest in a singular company or stock is a key draw. By taking the time to research a company or stock, the better you can understand if it is suitable for your risk tolerance, has a legitimate business offering, and has the potential to grow and ultimately increase in value. So we've broken it down into steps that you can take. Start with first deciding what company you want to invest in. This can begin with deciding on what sector you want to invest in, and then zeroing in on a particular company that can help you meet your investment goals. Next, you want to dive deeper into understanding the public reports available on the company. These reports are usually available on the company's website, but can also be found on the EDGAR website for the U.S. Securities and Exchange Commission, SEC filing database, or CEDAR for reports and documents filed with the Canadian Securities Administrators. At this step, you're looking to understand how the company makes money, any risks the company faces, like high debt load, for instance, and the company's history, including its revenue, cash flow over time, planned projects, and new sources of revenue or business models. Once you feel confident that the company's reporting, next move into understanding their financials, where the rubber proverbially meets the road. This information can be found in the company's annual report and 10K report. Here you can learn about the company's net income, which shows the company's gains or losses at the end of the quarter or year. Its PE ratio, which measures the company's current share price against its per share earnings. And finally, its return on equity, which helps you determine if the company is using its investment money responsibly for the growth of the business. Next, you want to move into exploring the company's industry. Here you can learn about the innovations, disruptions, and opportunities facing the company in question and the potential it has for growth. This is also time to dig into the competitors in the space and whether the company has the right financials and business opportunities to do better than their competitors. You may find that a competitor might be more to your liking and what you'd want to invest in. Following the step, examine the company's leadership, both board members and the executive team. The purpose of this step is to understand if the company has the right folks making the key decisions for the company's growth. By looking at each board member and their background, management style, past accomplishments, and issues they may have had in the past with previous companies, you can better decide if the company has the potential for growth under this leadership. And finally, once you're done this step, you can begin looking at additional information to round out your research available by experts on the company or industry. This includes things like Bloomberg News, Morningstar.ca, TMX.com, or Nasdaq.com. It's important to remember that you do not want to have confirmation bias here by only looking at reviews or articles that align to your views about the company. You want a broad selection so you get a very unbiased look at how this company is tracking to perform in the future. Once you've completed these steps, you are ready to invest. And it may seem like a lot of work, and it is, but this research is fundamental in helping you decipher the potential of a company and its potential for growth and value over time. By doing this, you can have a better chance of investing wisely in companies to meet your financial goals. So now that you have a better understanding of opening a self-directed account, creating a financial plan, the types of investments available to you, and how to research an investment, let's break down the common DIY investing mistakes and elements of your psychology you must contend with. First, we must start with the common mistakes. So the first is investing before researching. I've already stressed it enough here, but researching is so critical to understanding the value of a security or investment, and really if it has the potential for growth. Not doing that, it can lead you down a bad path of potentially even getting involved with a fraudulent investment if you haven't done your research. Not identifying your financial goals. It's really important to identify your financial goals and tie your investments to those goals. Without those goals, you're kind of just rudderless in the ocean of investing, and it can have you making weird, abrupt changes on the go. So make sure you tie it to your financial goals and what you're trying to achieve. Getting caught up in unsuitable investments. You know, as we look at investments and look at DIY as being something you manage completely on your own, it's that much more important that you recognize and listen to your risk tolerance. By ignoring it and getting involved with investments that are not suitable for you, that will keep you up at night and has potential to lose a lot of your own money. So remember that no one cares about your money more than you do. And by taking the steps to invest in line with your risk tolerance, the better off you are for it. And not knowing your risk tolerance or comfort. I hope that everyone goes to checkbirds.ca and takes the risk tolerance quiz, because you should know what your risk tolerance is before you ever get involved with DIY investing or any type of investment to begin with. So take that quiz and learn what that is and stay within it. Common DIY investing mistakes, part 2, ignoring the risk of the investment. So many people get attracted by the potential growth of investment, the ability to make a lot of money, and they forget that there's a huge risk behind it. Remember, high risk, high return. So if you're thinking of just the high return part, you're missing on that critical element of that high risk that you might lose this money that you're not intending or wanting to lose. Having too few or too many investments. Having too few, if you're investing in just 1 or 2 companies, if the stock market goes bad for those 2 companies, you can see massive losses. And at the same point, if you have too many companies, what the industry likes to call diversification, that's when you have too many to handle. Think about that garden. If you have too many plants planted and you can't keep track of them and you can't water them all on time, you're going to have some wither and die. Remember, it's about monitoring and continuing to research them. So if you don't have that ability to do that, You might have too many investments. You want to find that perfect amount that you can manage. The next is ignoring investment fees. Investment products, whether it's through a firm or whether it's through a financial institution, they all have a fee involved with them. And if you're using online brokerages, there's also fees for conversion from different currencies from Canadian to US, as well as for buying different types of investment funds. Make sure you understand what these fees are, because as your investment grows over time, you will see that that percentage of that goes to fees will grow, and you have to understand if you're comfortable with that. Not monitoring your investments and their performance. Make sure you monitor them. Carve out maybe once a month or once every 2 months to see how they're performing and see if there's any inconsistencies or peculiarities that you need to look into, and see if you need to change some of your securities within your portfolio. But by monitoring that, make sure that you can keep abreast of any of those changes as they happen. And last but not least, and this is so important for DIY investors, but social media and online investing trends. As DIY investing has grown in popularity, so too has the online forums and chat groups dedicated to discussing, speculating, and boasting about investment returns and overall portfolio performance. Remember that as DIY investors, your greatest tool is staying focused on your investing plan and cutting through the noise with diligent research and judicious judgment on what investments make sense for your portfolio. Always consider the source of investment advice. The person offering it could just be speculating, inflating, or improperly communicating information, and worse yet, be a fraudster trying to onboard new investors to their pump and dump schemes. Remember that stocks like GME and AMC that have been blowing up on Wall Street bets is due to a rallying of like-minded investors to get in on stocks to grow its value. The major problem here is that it's not tied to the fundamentals of the company's performance, and as such, makes investing in them a gamble. So make sure when you're looking at all the speculation that you cut through it and do that research. That will help make sure that you're investing in the fundamentals of a company and not just this frenzied hype that can come from online. Remember, consider the source of the investment advice. Anyone can go online and provide investment advice. Is that credible? Online chat rooms are unregulated and information can be speculative. Someone could make up information right off the bat saying, I just have a feeling that this company is going to grow 3 times in the next year, based off of nothing. And that's something that you should recognize as you put your hard-earned money based off of that speculative guess. You're basically putting your money up to that person's guess. Don't let that happen. Do that research. Others may inflate or improperly communicate their investment returns. And this is something that might lead you to feel like you're missing out by hearing someone saying, oh, I grew my portfolio by 300% this year, when in actuality, maybe they only grew it by 7%, but they want to look, popular and successful online. That might lead you to follow them into investments that are not really right for you at all. And always check the validity of any investment and the registration of the individual or firm offering it. If anyone offers you investment, with the rules and laws of Alberta Securities, they must be registered in Alberta to sell securities. So right off the bat, check the registration, see if they're actually registered to be offering an investment, and check the validity of the investment. Do that fundamental analysis and check if it's a legitimate company. Now we'll move into the 5 cognitive biases. And investing behavior is not defined just by the act of buying and selling investments, but also the psychological traps and misconceptions you must contend with. So let's go through these. Overconfidence effect. This is a well-established bias in which your confidence in a judgment does not align with your actual accuracy and results. In investing, this can lead you to overestimate your understanding of the stock markets, ignore or disregard information, expert advice, and take greater risks than is suitable for you, and ignore red flags of poor investments and fraud. The next is herding behavior, aka FOMO effect. And this is often linked to wild and irrational stock market bubbles. Herding is a tendency for us to want to follow the crowd. The fear of missing out on the next big investment can influence you to make investment decisions in line with what you see and hear from others, and less so on the fundamentals of the company you're considering. Fundamentals include profitability, revenue, assets, liabilities, and growth potential. Remember, you want to track to those because that can tell you the true value of a company. The next is confirmation bias. And this is when you have preconceived notions about a company or investment and seek out information that supports your beliefs rather than building a comprehensive understanding through objective research and data. This bias can make you invest in companies with a skewed sense of its business potential. Next, loss aversion. And this is a tendency for you to place more importance on losses rather than gains. This can lead you to hold on to a stock that continues to drop in value while all current rational analysis tells you to sell it. Inversely, this could also have you selling a stock that went up in value slightly to realize a small gain, while ignoring analysis telling you that it should be held longer for much greater profit. And finally, anchoring. And this is when you anchor your opinion and value of an investment to one piece of information or price and ignore the company's fundamentals. Worse yet, anchoring can quickly lead to confirmation bias, having you look for additional information that aligns with your anchored belief in the stock, helping to perpetuate the anchoring. So, final thoughts on DIY investing. Keep in mind, past performance is not an indicator of future performance. While stock may have done well in the past, that is by no means a guarantee that it's going to perform just as well in the future. You need to do that fundamental analysis to understand if it has the potential to keep on growing. Rely on company fundamentals, not hype. Company reports, financial public filings, leadership. Time in the market always beats timing the market. The more you can keep your investments in the market and compounding over time, so interest on the interest that you've already made on your investments, the more your investments can grow and you can rely on that. If you focus on buying investments constantly throughout the day, you are really subjecting yourself to a very high stakes gamble in terms of making sure you come out with a return. And it's very, very hard to do. No plan, no financial plan, no research, it makes you an easy target for fraud. If you're directionless with your investing and you don't do any research, fraudsters love those types of people because that's when they can sell a very, very eye-watering inducing investment that can grow them or make them lots of money, when in actuality, they're not legitimate. And because they're not doing research or have a financial plan to tie it to, they can really get you in on it and lose a lot of money. Diversification of assets reduces risk. This is so important. When you're looking at your investment portfolio, you want to weather the storms. And storms are always going to happen. We had a pandemic and we're in a pandemic still. Oil and gas, had moments of a downturn. It's starting to look up. But these are all elements of your investment portfolio. When you're thinking about this, make sure that you're investing in a broad selection that comes over these different landscapes, different technology or different sectors, different global markets, so you can hedge your risk and lead to steadier returns over time. And you do not have to invest strictly in stocks, aka active investing. As a DIY investor, you can also use passively managed index funds or ETFs to achieve your goals, and that's perfectly fine and is a great way to do it because over the long term, studies and research has shown that has outperformed active investing. So it's a great route to go to if you're a DIY investor. So if you want to learn more about things like stock market overviews, investing in compound interest, financial planning, fees and charges, tax considerations, we also offer Investing 101 courses held through Calgary Chinook Learning College and Edmonton's Metro Continuing Education. And these are held virtually, so you can also sign up for those. So visit Chinook Learning Services or Metro Continuing Education to register for those classes. And they're coming up in October as well. And I just want to remind everyone that there's free and unbiased resources at Check First, video learning series, quizzes and calculators, so you can do that risk tolerance quiz, fact sheets, and check registration, an important tool to make sure that whoever's offering you an investment, whether it's a firm or an individual, is registered to be doing so. And of course, at the Alberta Securities Commission, you can always contact us if you've come across a suspicious investment or been offered one, or you feel like you've been invested in what you think is a fraudulent investment. We can always help you. We're always here to help you. So you can contact us. And suitable complaints include securities fraud, investment fraud, insider trading, stock promotion, selective disclosure, unregistered individuals, and Ponzi schemes. But if you don't know what organization your particular scam should go to, contact us anyways, and we'll direct you to the right one. You can follow us at ASC Updates on Twitter and Facebook, and Check First on Instagram, where we have a wealth of content that we share weekly, and it provides you with updates on investing trends, types of fraud that you might see with investing, and just really investing basics, which can help you as investors grow your knowledge. And I welcome everyone to go to checkfirst.ca/subscribe and subscribe to our monthly email where we provide unbiased investor information and investor alerts directly to your inbox. And it's a great way to inject a little bit of that investor knowledge into your monthly research. And finally, you can contact us at 1-877-355-4488 if you have any concerns or questions, or you can contact me, james.mctavish@ac.ca. With that, I want to thank everyone for joining me for this presentation.